There we go. Hi, here we go. It's exciting to be here today. This is the first time we've done a live recording and a live interview with Susanne Chishti of Fintech Circle. How long has it been, Susanne? How long do you reckon?
I was just thinking, Glenn, probably before Corona that we did the last Ask Me Anything session, so a long time. So it's exciting to be back.
Oh, that's fantastic. That's fantastic. So we put it out into our LinkedIn group. And so this is a great opportunity for anybody to ask a question, post a question that you would love to have answered by Susanne. I have to say in the last month or so from the events we've been doing for the Swiss banks, your masterclasses, and also with the bank here in London, which I won't name, but yeah, the wealth of knowledge that you have, Susanne, I have to say from the heart. Every time I see you in person delivering the teachings, I'm like, oh my God, you know so much. Actually, yeah. I was going to say, actually, just before we begin with the first question,
Yes.
could I just ask you, could you just tell us a little bit about the background? What made you start Fintech Circle? I just think it's such a nice story. Could you share?
Yes, sure. I mean, as background, I guess is I came from the technology sector originally. So I was, when I go back 25 years ago, after my university finished, I started to work for Accenture as a consultant, and I was coding C++. So I came from the technology side. Then I moved into the banking side, joining Morgan Stanley, working for Lloyds Bank, for Deutsche Bank. And so then all of a sudden, when fintech became a thing, became well known, I thought my life makes sense now all of a sudden, because technology and finance comes together. Finally, there's got its own term, which is fintech. And then what I saw working in a bank, in 2014, was that lots of bankers, were all stuck in their own offices, in their own city offices, but did not understand where the fintech startups were, because these were two completely different worlds. And as a person in financial services who wanted to know about the future of finance, like many other people want to know that, we wanted to reach out to those startups, but we did not know where they were and where we can find them and talk to them. And so this was the idea behind Fintech Circle, where I thought it would make so much sense to really work together closely, and those people in banking who want to invest in startups to be able to find the best startups with the best ideas, the best management teams, who want to get and raise capital to really scale up their businesses. And this was the idea, which generated, or which was, and so Fintech Circle was born, based on this idea. And we started out, being an angel investor network, consisting of people in financial services who want to invest their own money into the top fintech startups. This was, a few years ago. And then in addition to our investor network, we added other things. We added our book series to educate people on fintech.
Sorry, that was me.
No
Turn
worries.
my phone off. Apologies. Educating people in fintech, you were
Yes,
saying.
exactly. We educated people in fintech. We educated people via films now with our partnership with ITN. So we did more and more things over time. But at the core, going back, Glenn, to your question, it was really because I thought I want our fintech startup sector, closer connected to the existing established players, and being able to invest, to mentor, to innovate together at the end of the day. That's why I called the company Fintech Circle, because it's about coming together, having literally a circle whom you can talk to and be connected with to get things done. At the end of the day, that's what we want to get done.
Really, and yeah, I think that connecting also the investors and the the innovative startups is so important. It was great to see at London Fintech Week London, the live Dragon's Den presentation on that big stage. It was really cool. Hey, just a quick question, because somebody posted it in the LinkedIn group, if you don't mind. So the social media following now is up to 216,000 and growing every day. That's a massive number. So how did you achieve that? you achieve that in the early days? How did you get the following up so high?
Yeah, a good question. I mean, it took many years. Number one, it was initially really hard work because when we started out, in 2014, people didn't know fintech. Nobody understood what fintech was, and so there was this huge need initially just to spread knowledge, to share what we could find ourselves. And so we started, with our LinkedIn group. We started with on Twitter, on Instagram, a few years later. But the idea initially was really about sharing, sharing things which I thought were interesting with other people who I thought would find it also useful and beneficial to get access to this information, to certain research reports, analysis. Then what we did as well was to try to see who are the players, who are the top entrepreneurs who change the world, who innovate successfully. And we wanted to feature them. So we went out, we looked what are they doing, and we featured those startups on our Fintech Circle homepage. And so, step by step, we grew our community. And as you said, now it's, 260,000 people, who follow us globally to learn about fintech every single day. And we're very proud of all of them. We are very happy to have everybody with us. And of course, the key thing going forward is to add value, to add more and more value every single day, so that everybody, no matter if it's an investor or if it's a startup founder, or it's somebody who still works in banking and wants to learn more about fintech, or it might be a regulator, it might be a technology expert, but who doesn't know about fintech enough. So no matter who our stakeholders are, we want to explain them the fintech ecosystem, how everything works, how everything fits together, and ultimately connecting them to the person they need to speak to next. I think that's what Fintech Circle is really all about. It's about connecting people with each other, via our events and via our various activities which we run.
Yeah. Can I feed in on that? Because it's a story I like to tell. Yes. Again, we won't name names. Not going to name the companies because I think Chatham House rules. But I know of the fintech startup who came to you looking for an introduction to the Central Bank of Austria. And had they gone in themselves just cold, there's no way they'd sort of make that connection. But I know you were able to actually do that introduction. So I think it's worth sharing that personal relationships and connections and introductions and connecting people is really what it's all about. It's at part of the heart of it, isn't it?
Yes, that's key. That's what we do for our members, for our Fintech Circle members. In our membership, that's where we help our members to get connected. And sometimes it takes many, many years to build up those connections. But once you've got them, you can of course help others to get into this inner circle.
Okay, so I hear that. And if anybody has any questions, just post them in the public chat there to the right. But some of the ones that came through earlier through LinkedIn. So here's the first one. So what are your best tips to raise funding in the current economic crisis? Because obviously things are tight at the moment. So what are your best tips to raise funding considering the current situation, economic crisis?
So, I mean, for, I think, startups in the UK, where we face, very much an economic crisis, high inflation rates, the highest in 40 years. I think the key things are to know that high quality startups will always raise money. I mean, that's the first thing, that you don't give up hope. If you are a high quality startup, you will always succeed in raising money. And what I mean with high quality? High quality, I do mean that there must be a very good reason why you exist. There must be a good problem you're solving. The solution you have developed must be, good. You must be able to evidence that there's demand, for the product or for the service you've got. And now in our environment, where the economic crisis is ahead of us, it's very important to be able to show that you're capital efficient. And capital efficient means that you are able to do a lot with a little money, or you're able to stretch the investment you get, that you spend it wisely. So it's not anymore about growth at all costs. It's really about how do you invest the money you get so that you accelerate the growth of your company, that investors see returns sooner rather than later. And at the end of the day, every startup has to reach at some stage in a moment where you become profitable. So investors nowadays look at what is your journey towards that. What are your unit economic costs? What are your detailed plans, in terms of sales, in terms of marketing, in terms of recurring revenues? How do you achieve recurring revenues on an ongoing basis? And so it's about really being focused, on the quality of your business to convince and network with investors before you need them as well. That's another important one, Glenn. We always say to people, don't reach out to investors when you are running out of money in 3 months' time. This would be the worst moment, because then you're most vulnerable and it's too late. But you need to raise money when you still have got at least 9 months runway, at least, ideally 1 year still to go. Then you should start thinking about raising money, because it takes a while and it might take longer in our current environment. So very important to start early, raising money, develop relationships with various investors. And it might be angel investors. Initially, it might be venture capital funds later, and try to do that all the time, almost. Even if you don't need the money, just make those connections. And then when you raise money, be well prepared. Have good slide decks, a very compelling story, and a good data room backing it all up, and be cognizant, of the economic environment where really quality goes to the top. That's what we see now, and therefore you need to show your capital efficiency very well.
Well, good advice and good tips.
Yeah.
Actually, I'm gonna take a moment there. On the 2nd of November, there's a good opportunity, isn't there, to come and network and meet investors and connect with other fintech founders. So everybody's listening, please make sure you check out the website under the events and conferences section. But we're having our autumn drinks in partnership with Deloitte on the 2nd of November. So that's a great opportunity to sort of meet investors. The last one, we had a couple of unicorns, didn't we? So yeah, good opportunity to network. Okay, so I can see a question here on the right-hand side. So I'm going to read it out from Dan Faheny. I hope I'm saying your surname right. I feel like I'm on the radio. Hi, Susanne. From fintech founders, CFTE, Innovate Finance, to even Tech Nation, there are a large number of UK networks to tell the fintech story. What would you envision for CFIT or CFIT launched with a 5 million government fund and seeking a CEO? Does that make sense to you?
Let me just check. Is it?
Yeah, it's in the public chat on the right-hand side. It's just the CFT launched.
Yes.
What would you envision for CFT launched with a £5 million government fund and seeking a CEO?
Yeah, I think what Dan refers to is that there's number one, there's lots of activities, in terms of associations, which help startup founders to work together to lobby the government as well to some extent, which is a great thing. And I think, therefore, what I would recommend for startups is often to get to know all networks, and see which one you like most, and really get engaged, with all these opportunities, and then choose, of course, because you can't go out every single night. You have to choose as well. But in terms of the CFIT, which is Ron Khalifa's review, exactly.
Oh.
Yes, I think it's a great thing that we will have that, and it will be a wonderful opportunity for the government to again show their support for the fintech sector. Because when I go back to 2014, it was George Osborne. He was the finance minister at this time, and he went public with his desire to make London the global fintech hub. And he said that at a time where London was not the global fintech hub yet, because nobody had a hub in fintech, but because the government had this vision, and everybody started to believe in it because it was very credible. It was very supported by Level 39's activities at that time, and so there was so much drive. It actually became a self-fulfilling prophecy. And Ron Khalifa, who is an incredible visionary, he wrote the Khalifa Review for the UK government 2 years ago. And as a result of the Khalifa Review, there are lots of activities coming out, lots of actions being taken by the government as well. And one of those is this new center, for finance, innovation, technology. And the goal ultimately is to ensure that the UK stays a very good place for fintech to thrive. That's the ultimate goal. And therefore, what it tries to do is to provide more funding, for startups, giving access to capital. But the review also addressed access to talents. So how can we get access to more talented people? And how can we make sure that those ones who are talented to grow the businesses here also list in London? So if they've got an exit, for example, that they don't go, to the Nasdaq to list the companies there, but list at the London Stock Exchange, and to encourage local listings here in the UK. So, very, very good point, Dan. Thanks for your question.
A very good one. And Ollie, our good friend Ollie Cook, he's just posting a question here now. He says, "Hi, Susanne. What do you see as the most exciting fintech areas over the next 12 to 24 months for early stage investors? What parts of the ecosystem would you like to double down on?" So what do you think are the exciting fintech areas for the next 12, 24 months for early stage investors? What parts of the ecosystem would you like to double down on?
So very good question, Ollie. And I think for me, there are three areas which I always, when I talk about the future of finance, I always talk about three areas. One is about embedded finance. So to embed, things, and maybe I'll tell you the three trends first, then I go deeper in each one. But one is embedded finance. One is about green finance and green fintech. And the third one is about financial inclusion. And so maybe I say a few words in each of those. So the reason behind embedded fintech or embedded finance is because when you think back, 10 years ago, we had every product was analog. We had mortgages, we had loans, we had credit cards, everything was also written down. We had hard copy papers. Now everything is becoming digital, and most things are digital already. And then we have got the second trend was the things which were analog, were discrete products. So we had discrete, services, products offered by banks. And we're in this big journey now towards embedding it all. And embedding means that it becomes almost seamless. So when I think about somebody who wants to buy a flat, you want to buy a flat, you need to have a mortgage, you need to get insurance sorted out. And that all takes lots of work, especially now, inflation, interest rates are rising. There's so many people trying to remortgage. It takes lots of work. And so if fintech would help, embedding all those customer journeys, you could in the future imagine that you would buy a new property and your mortgage would be arranged for you in the background. And the insurance policy would be arranged for you in the background, based on what you set as your targets, how it should look like and what your target, kind of expectations are in terms of duration and fixed interest rates or variable rates and so on. So those things, we see this embedded trend. And the second trend which I spoke about was green, about ESG, about sustainability. That's something which becomes so important. I mean, we all have seen more and more how our climate change has led to a crisis. A crisis globally. We've seen the flooding in Pakistan, just in the last month. We have seen fires, across Australia and California. We have seen, I'm Austrian, and I went back to Austria over the holidays, and there's one lake, close to my family home, which almost dried out. So even in Austria, you can see water levels have decreased because of our higher temperatures. And we can see that, everywhere in each country. And so it's the responsibility of all of us and all companies to do something about it. And of course, green finance and green fintech startups, such as, Ollie's startup Echo as well, does the right thing by helping us as individuals to measure our carbon footprint, in a much easier way, but also helping banks or financial institutions to find solutions which they can offer to their millions of clients in order to do the right thing as well, in a way which is easy for people as well, in order to save our planet at the end of the day. So I think it's, we all have to act. So this is a second trend. The third one was about financial inclusion. There are so many people who are excluded from financial services. And it's not just in emerging markets. I remember a time, where we all looked at Africa and we looked at Asia and we said, okay, there are millions of people who have no bank accounts, but it's not a problem which we have got in the West. But that's wrong, unfortunately, because we know in the UK alone, there are 4 million people who have got no bank accounts. And there are a big portion in the UK, who now in this winter, have to choose between heat or eat. Apparently 40% of the UK population which has to choose between heat or eat, which is completely unacceptable. And also in the States, when you look at the States, there are 40 million people with no bank accounts. And I think it's almost half of Americans have got less than $400, in their savings pot. So if anything breaks, they are in difficulties. And so I think financial inclusion, helping people to save more, to spend less, to also save for their retirement, to ensure that we are not all poor in old age, but that we have got savings to rely on. Those things are super, super important. And that's where also financial literacy comes in, because when I think about lots of people who retired in the last, 10 years and who took out pensions which were not inflation pegged, so they will be in deep trouble now. Because now where inflation is 10%, and if your pension is not pegged, to inflation rates, your pension will deteriorate so quickly that there will be nothing left. And you can't start working again when you're 70, So those issues, I think our society is facing, and that's where, lots of fintech companies will be able to play a very significant role.
There's just adding into that on the financial inclusion, there's something I've heard you say a number of times, which is it's expensive to be poor. It's expensive to be poor, which just isn't fair. And one of the examples is that it's sort of like if you have a gas meter, the coin meters, because they still exist, but they're paying, far more than the average Joe who's on direct debit. So the poorer you are, the more expensive it is, isn't it?
Yes, it's shocking, exactly.
Okay. Well, we've got some questions coming in. So Dan again. So the question is, are fintechs and neobanks prepared for the FCA's consumer duty?
Yes, I think in reality, not everybody is prepared yet. So I think companies are on their journey. I think it's a very good thing that that's more a focus, to do the right things for consumers. And it certainly is. It's a topic at boards. At boards, people talk about how can we do the right thing for consumers, because the FCA focuses on that more and more. So yeah, a very important area of development where more needs to be done.
Closely followed by the next question, I'll feed into that. And it's from Jerry, who we know well. Jerry says, hello, Susanne. How will the SEIS investment increase to 250,000K convince angel investors now that startup investing has cooled? So how will the SES investment increase to 250K convince angel investors now that startup investing is cooled? Do you want to?
Yes, good question, Cherry. So hello to Cherry as well. So this was at the last budget. I mean, you all probably have followed the news on Friday in the UK. We had this huge mini budget happening, which
mini budget,
which was huge in reality, and led to a deterioration, of the sterling. It's in free fall at the moment. The whole financial market is in shock. Nobody expected to to improve and to reduce the tax for rich people, in an economic crisis. I think that's probably the bottom line, that people think it was not a very sensible, thought out budget. And but one good thing, I guess, for our sector definitely is the £250,000 increase of FCAs. And so far, all startups know so far it was £150,000, but from next April onwards, it will be 250. And what this means is that startups will be able to raise the first round from angel investors. And angel investors, because they invest in the SCS round, they will get a 50% tax incentive. And so, to the Jerry's question, I think that's a great enhancement. And the reason why that's important is because, as angel investor, normally you have to assume that if you invest in 10 companies, 5 companies won't make it, and among the other 5, probably 3 or 4 companies might be, what investors refer to as the living dead. And living dead means, the companies are doing well, and they might be even profitable, but as a minority investor, you don't get your money back. Because the company doesn't pay any dividends. And so if you hold 1-2% shares, it doesn't, you never get your money back until there's an exit. And so you would hope as an angel investor that 1 out of your 10 companies, at least, but hopefully 1 will be the company who exits. That's the time you get your money back. I mean, unless there's secondary trading in your shares, which of course would be an opportunity to sell it as well, but that's not often the case. And so what this basically means is that angel investors get rewarded for taking this enormous risk. It's like 1 to 10 chance, to basically choose wisely by having a larger portion available for SCS investment. And under SCS, they have got this 50% buffer. So any investors, who are on the phone, what this means is if you invest, let's assume you invest £10,000, and you will get £5,000 back in your tax return. So in reality, you only invested £5,000. So if the company doubles up, your 10K becomes 20K, because of the 50% tax relief, you actually made 4x now. Because 5K, your stake now is worth 20K, so it's 4 times more, so 4x. So that's the important way how SCS works and why it is such an attractive structure. And again, in the UK, we are the only country who offers that. So I don't know any other market who does. And it's great that, the budget has increased this to 250K, Cherry. So it will be very positive, for investors, and will definitely encourage more investors to invest more because of that.
Yes, I was going to say, actually, that I might take the opportunity, forgive me, to plug again the 2nd of November, simply because that's the panel discussion at Deloitte's, isn't it? As well as free drinks and getting together with investors and all the members. The panel discussion actually is with Chris Hill of Deloitte's on SEIS, etc., isn't it?
Very true. Yes. So we will talk about SCS, we will talk about EIS, we will talk about investment tips, with Chris Hill from Deloitte, how to raise money in difficult times, how to exit, how to prepare for that, from the beginning, so that you are prepared that at the end, when you actually want to sell your company, you have got everything you need to maximize your valuation. And that's really important to do this early on. So we will cover all those points, and also things which can go wrong, So I remember, you all know Innocent Smoothie, a little story, Glenn, I will share. But Innocent Smoothie, they were purchased by Coca-Cola, more than 10 years ago. And the issue Innocent had was that their trademark was developed by a contractor at the beginning of their lifetime, and the IP of the brand was not passed on to the startup.
Really? Oh my God.
And so what happened when Coca-Cola wanted to buy Innocent Smoothies, they realized that the trademark, the brand, wasn't owned by the company. This, of course, was so valuable at that time already. And so then, the contractor got a call and said, can we buy your IP? And of course, he realized there was something going on. He, as you can imagine, charged an incredible amount.
I bet he would. Oh dear.
For something he would have probably, we have given away for a fair price at the time it was done. So those things you have to avoid at all costs, to kind of making sure that you do all the right things as a startup early on, so you don't get haunted by them, when you want to sell at some stage.
Comes and gets you later.
Yes.
Indeed. Well, thank you for that. Thank you. Next question then, from Gurav. I hope I'm pronouncing your name correctly. Hi, Susanne. What's the roadmap of a fintech career for those who have only CFA finance background? What kind of skills are needed for a career in fintech? What's the sort of roadmap, would you say, if you only have a CFA finance background?
It's a great question, Gaurav. And I would say, you said only, I think to have a CFA finance background is fantastic. That's already a fantastic starting point to have that and have those exams done. So that's an outstanding starting point for fintech. I would say in terms of roadmap in fintech, there are lots of different choices. There is a choice of joining a startup as in any area. You could join in product development if you've got great ideas of what new products should be launched. You could join in marketing. You could join on the technology side, to help test new products, or to help collect requirements from users, how new apps should look like. So there's lots of things on product development. If you understand how the regulators work, as part of your exams, you could become and join and work in the compliance teams, because more and more established fintech scale-ups, they all need compliance teams. So you could work in the compliance area, or you could work in the customer facing, in the sales side, to sell, if it's a B2B company, sell back into financial service institutions, which you might know better than somebody who's never worked, in a bank or in an insurance company or in an asset manager. So there are lots of roads, and the careers within fintech become very diverse. I would say there's everything for every taste, every appetite, is available now. And the good thing is that at the moment, our unemployment rate is very low, for the whole country. And at the same time, there are lots of jobs available. So I know, I'm on the board of a UK bank and also on the board of a FTSE 250 company. And both of those companies, one is Crown Agents Bank, the other one is CMC Markets. Both have got, CMC Markets has got more than 100 open positions. And Crown Agents Bank has got below 100, but it's close to 100. So can you imagine if two institutions look for 200 people, just two companies, and there's so many open positions out there. So it's just a question of looking, looking what's available, applying, and learning. And I think initially when you start your career, you want to learn, you want to think and choose those industry areas where you can learn the most. And of course, in fintech, you can learn a lot, because when you join a company where you get lots of exposure, you can learn a lot. And then you become more and more valuable. And I think that's at the end of the day, that's your goal, as an employee. You want to become more and more valuable, because then you can, of course, raise your salaries, and you can, run your own business at some stage, and you can become, if you want, your own entrepreneur. And so there are lots of great opportunities in fintech.
Thank you for that. That's very interesting. Another one from Jerry. He says, are investors currently interested in a quick exit or selling their initial investment on the secondary market?
I would say in general, most investors, and I'm talking now about literally everybody, so private equity, venture capital, angels, everybody loves an exit, so that's definitely the case, Jerry. But of course, it comes down to at what price, because if you think your company is worth a lot and you could get a kind of a quick exit now, but at a very low valuation, you might not want to go for that, because you might think, if I wait for another year, and then the valuations will be better, then I can exit at a higher price. It's always, I think, if you are running a business, you get an offer to buy your company, it's always weighing up. Is the offer good enough that you take it? Is it not good enough that you better wait? Then, of course, you have to weigh up, does this offer come back? Will the economy get better over time, and will my position as my company get better over time? Because it might be that the economy looks out better in a year's time, but maybe that there are new competitors in the meantime who entered the market, who then make your company less attractive, for potential buyers. So there are lots of variables to consider, and the other variable, of course, is in terms of how does the founder get rewarded. Sometimes you've got exits where the founder and the person who sells the business gets shares in the new business. Some people like that, other people don't. Other people prefer cash. Some people just want money and I want to walk away and go to an island and rest in the sun under the palm trees. So some people want money, basically. And so it depends, what type of lifestyle do you want after the exit? Do you still want to be employed, by the new company, or do you want to cut your ties, and do something new? And those things all are very much bespoke. And I remember, I was part of an exit when I worked for a fintech company, which was a few years ago. And this company was called SafeCharge. And SafeCharge was acquired by a Canadian payments company for £700 million. So it was a huge exit. And the nice thing, it was literally in cash. So the company founders could walk away with millions, and the company did very well. Even now, it's made the new buyer, which is Nuvei, very successful. So those things need to be all considered. And in terms of secondary market, to the second question which Jerry asked, the secondary market is something all investors want to see happening more and more, because what it means as an investor, normally, the risk or the disadvantage of private investments is that they are illiquid. Because if I buy IBM or if I buy Apple, the stock market, I can buy today, sell it tomorrow. It's 100% liquid. But if I buy a startup, I might not get my money back for 10 years. If I'm lucky, I might never get my money back. If I'm lucky, I might get it back in 3 years and have an exit in 3 years. But I don't know. It's definitely not liquid. I can't guarantee a moment when I get my money back. But if a secondary market exists where I could sell my shares to other investors, then this is an option. So I give you an example of one secondary market provider, which is Cedars. Cedars, where I'm a venture partner. And what this means is that I recommend, to Cedars which fintech companies could be a good choice for them. And Cedars offers a secondary market, so which basically means if you have, let's say, bought into Revolut and you're a Revolut shareholder and you want to sell your stake in Revolut, you can sell it on the Cedars platform, on the secondary markets platform, where there are lots of people who want to buy, other fintech companies. So that's something which is really valuable. The key thing always, of course, in a secondary market, again, is the price. So at what price do you sell your stocks? Because on a public market, there's lots of demand, supply, which sets a balanced equilibrium price. So you're getting the fair share for your equity. But in a secondary market, the question will be how much liquidity is there? How fairly priced are the available securities? And but the best one I know is the one, from Cedars, which offers a secondary market as an opportunity to sell out, if you are a private investor in private startups.
That's really good advice on that one. A question here from Dan again. He says, and this is a good question, when should an early stage startup assign an external advisory board? What's your advice there?
A good question, Dan. And I think there are two advisory boards. One thing is an advisory board which has no fiduciary duty, and one is a corporate board which is a director of the company. So I would say, in terms of advisory board, which with no fiduciary duty, so those people are not listed on the company's house as directors, I would say as early as possible, because it's never bad to have good advisors surrounding you. And it always looks great. I mean, we see lots of startups raising money who put on their slide deck who is advising them. And the more senior the people, the more, influential, the more we believe the startup has done a good job in convincing others to believe in them. This again adds to their credibility. So I would say to have an advisory board, you couldn't start, you could do this from very early on. It helps to shape probably your business strategy or to validate your assumptions with experts in the field. You don't necessarily have to pay them anything. Often people are honored to be on your advisory board, and they're honored that you ask them for their views. So that's one thing. The other thing is having a board. Having a board means you've got other companies who are directors of the business. Those directors can be shareholders, but don't have to be shareholders. So the board positions I'm on, at other boards, I'm not a shareholder. These are large companies. As I said, it's a bank and it's a FTSE 250 companies. I'm not a shareholder, but I'm a board member. There's a board member, you get paid, but you also have got a fiduciary responsibility, which basically means if anything would go wrong, you are responsible because you're director of the business. So you need to look after, you need to govern the business well. And so if you're a startup, you have to think about, when do you need to have such a board with you? Normally it comes when you raise money. When you raise money, at least, or at the latest, when you raise institutional funding from venture capital funds, for example, they often, but it can also be at angel stage already, where angels, with a large round, they want one angel to be on the board, either as an observer or as an actual having a proper board seat, with voting rights. And then having these board members, then you have to decide what decisions are being taken at board level and what decisions are being taken by the executive committee, so the exco, below, and where do you need, sign off at board. But it definitely helps. As soon as you start raising larger funds, larger amounts, you need a proper board as part of your governance strategy to make investors confident that you spend their money wisely, that you've got good controls in place, to really scale up your business.
That's solid advice there, definitely. Okay, the next question then is from Danica Medeiros. She says, "Hello, Susanne. What do you believe is the top misconception about what fintech is?"
That's a very good question, Danica. So I have to think about that. I would say initially, probably it was the conception that fintech is all about B2C products. It was about having an app, to pay, like a payment app, or it's something you can see. So I think the conception was fintech is almost easy because it's something, all things you can easily see, easily understand. But fintech is so much more than that. Fintech includes the whole areas of capital markets, includes how to issue securities, in how to issue a debt instrument, an equity instrument, and how can you, or think about prime brokerage, in corporate investment banking and hedge funds. How can you make also those very complex financial stakeholders' lives easier, cheaper, faster? That's what fintech is also. So I think the initial misconception definitely was, fintech is B2C only, but we have seen now it is much more than that. It's B2B. Now, I also argue fintech is also B2G, and B2G means business to government, because as we've seen, regulators use fintech solutions, use regtech solutions to regulate the market participants. So even that is also fintech. If you help the regulators to do more with regulatory reporting, transaction reporting, that's also part of the fintech universe. So fintech is very broad. It's really about technology, innovation across all parts and all areas of financial services.
Very good. Thank you. I'm going to, so if anybody just on the live call wants to post a question, just put it there in the chat. But earlier, oh, there we go. Thank you, Jerry. There's one coming. Jerry says, how do you see the future of DeFi? How do you see the future of DeFi?
Yeah, I think, Jerry, I think it is the future, number one, so I think when I talked about these three trends, before, from analog to digital, from discrete products to embedded. And the third thing is from centralized to decentralized. So these are the three big themes which we are seeing in financial services. And decentralized finance allows to reinvent almost financial services. It allows to look at our world in a different way. And of course, it's very we have seen, when you think about the whole cryptocurrency world, using, of course, blockchain technologies, using smart contracts, using and therefore allowing, empowering, business models which allow decentralized finance to be embedded or being explored by more and more players. And what we've seen is, the benefits, of course, are wide. The benefits, when you think about assets which are very expensive, like property, with decentralized finance, you can fractionalize real estate ownership and allow smaller investors to own a small stake of a large building, and therefore benefit if corporate real estate goes up in price, because they have got a stake, in this big building, in a way which wasn't available before. So you can see it's beneficial for investors, beneficial for issuers, because they can issue securities faster, for example. It's also beneficial for regulators to some extent, because when you think about the blockchain, it can't be deleted. So when you think about that, somebody would want to hide something, before the FCA or the PRA or the regulators globally, you can't do that almost on the blockchain, because it's immutable. And so even regulators will see their benefits, from our decentralized infrastructures, I think. But there's still, of course, issues with that. Some issues we've seen in terms of cryptocurrency with volatility. The last 4 months, we've seen the collapse of a stable coin, where we've seen that some stable coins are neither stable nor are the coins. So there was a big collapse happening. And now, we know we've got Tether, we've got, US dollar coin by Circle. And so the key issue for stable coins, is how stable are they in terms of how much collateral is underneath. Because if you buy a stable coin, US dollar, you want to be able to convert this coin into $1 US every time you choose, any day to choose. And the other side can only guarantee that if their collateral is strong enough. If they don't hold enough dollars, they can't guarantee that you could convert it. And that's what happened, 3 months ago, where it all collapsed. And so we've seen a huge volatility in the cryptocurrency space lately, which scared, lots of investors. Also, we've seen lots of people losing lots of money because there was lots of irresponsible marketing going on. I had a conversation just last week about some marketing having taken place on TikTok, by influencers, often which are actresses, actors, who have no understanding about finance at all, but they try to promote a certain cryptocurrency because they got paid to do that, and then people buy it, and then they lost all the money, and then there were suicide hotlines literally emerging, people to call up because they lost, their life savings. So these are horrible stories. And of course, the issue with the cryptocurrency world is still that it's deregulated, and that all these controls which we put in place in the existing financial services markets, such as market abuse, is not allowed. Market manipulation is not allowed, or front running is not allowed. All these very obvious things to protect investors don't exist yet in cryptocurrencies. So it's perfectly okay to abuse the market. And we've got, these whales of people who own so much cryptocurrency that they move the market, and front running is allowed, so all those things. And that's where it's still, it is still the Wild West to some extent. So you have to invest. If you invest very, very wisely, and I always say, don't invest any money you can't afford to lose. But I would say DeFi overall, coming back to your question, Sherry, is here to stay. Decentralized finance is here to stay and will offer huge opportunities. And I've just yesterday seen the statistics which said that we will have, digitally emitted securities in such an extent that about, I think it was 27% of our GDP will be generated by digital emitted securities and by the digital world, which is incredible. So I found it very, very interesting how much we're moving and how fast we are going to move in this direction, because numbers said by 2027, I think was published by the World Economic Forum.
Just for the simpletons out there like myself, no, just when you say digitally emitted securities, just break that down so I can hold that exactly. A digitally emitted security would mean.
So it could be a security, which is emitted, for example, on the Ethereum blockchain, where then people who hold digital wallets can hold in the digital wallet a portion of this stock, of the security. And then if you wanted to pay a dividend, you could do this again via the digital wallet. So you would not use anymore our existing stock exchanges to trade, which is centralized powers, but you could decentralize it in a peer-to-peer fashion. But of course, still using centralized service providers such as wallet providers, for example, so there is an opportunity to do much more, do it cheaper and faster, but still it's not yet regulated very well. That's Glenn comes to your point of protection of investors. Here much more needs to be done.
It was just last week, a new potential member of Fintech Circle was showing me his phone, and he'd lost $4 million from where he was to the crash to where it was now. A loss of 4 million. It's like, ouch. Okay, so we've still got another few minutes or so, counting down. But let me pull out a question from LinkedIn. Well, this is a good one. This is a really interesting one. Why are there not more female investors out there, Susanne? What are your thoughts?
Yeah, I think there are many reasons. I think one reason is, and it's for all female colleagues, on the phone as well, is that in order to invest, you need to have money first, and in order to have money first, you need to have been able to have jobs where you earned lots of salaries and lots of money, basically. And what we see when I go back into companies, often we don't see enough women at top leadership positions, where you would have access to high salary packages and lots of income. So I think that's one reason. One reason is that we don't have enough women yet who are, it's getting much better, but it's not equal yet. Ideally, we want to have an equal situation where we've got as many rich women as we've got as many rich men, but we're not there yet. And in order to invest, you need to have money. That's clearly the case. So we need to help women to earn and achieve more wealth in their lives, and then be making them able to reinvest that money by explaining the benefits of a diversified portfolio, because it comes down to understanding what your options are, what are the various asset classes you can invest in, what are the risks and return opportunities from equities to bonds to funds, to real estate, to commodities and to private startups, and to make sure that women understand that and men as well, but I think that women are brave enough and see the benefits in becoming investors in startups because of this huge potential to really change the world as well. As an investor, you've got more say as a non-investor often, and so you can focus on the areas which are valuable to you and which you believe in as well. You can back those companies you believe in. So I would say we need to have more female investors, yes, but in order to get them, it's not enough just to tell them, but we need to empower them in order so that they can actually become investors in the first place.
I was going to say we've got another 7 minutes left, so I think we've got time for 2 more questions. So this one I think is one from me. I'm going to ask one myself.
Yes.
You often talk about the pension time bomb. So just as we were talking about female investors, I know that pension time bomb, there's an angle on the future for elderly females as well. Could you just tell us a little bit about the female pension time bomb? And your thoughts on it and the concerns.
Yes. So the pension time bomb is a term which refers to the fact that most of us have not saved enough for retirement. And that's a big issue, but by the time you figure this out, it's too late to fix it, which is the hard thing, because you need to tell people in their 20s, ideally, start saving for your retirement. Because if you save in your 20s, you need to save very little amounts, but because of compound interest rates, it goes up and up and up every single year. In your 30s, you would have to save more, in your 40s, even more. But if you wait until your 60s, it's almost too late. It's never too late to save, but you don't have much runway to use this huge term, which is compound interest rates in finance, to make it work for you and to allow basically your savings to work overnight while you sleep to make you wealthier. And that's what this pension time bomb is really all about, is how can we get this message to people, to start saving early and to start saving enough, and to also avoid getting indebted, And here, of course, we have got one industry, which is buy now, pay later in fintech, which is in danger of doing the opposite, which kind of says to people, buy now and pay later. And as a mother, of teenagers, I always tell them, only buy what you've saved before, so only save first and buy later. But certainly don't buy now and pay later, because that's the first step into debt. And I know that, buy now, pay later companies would argue now, if you pay it back on time, you don't pay any interest rate. I know that's the case, but I think it's about the philosophy, we need to instill, in even young people at early ages, don't spend money which you don't have. Because if you do that, you can't save it. Ideally, you want to spend less than what you have in order to start saving. And if saving you allows you to invest, and then this allows you to invest long term as well. So that's what the pension time bomb is all about. It's about financial literacy, but also making it easier, to allow people to save more, and being, as a government, from a government's point of view, the government in the UK set up a default pension scheme nest, which is very important because it allows, when you start a new job, you automatically get enrolled in a pension now. But it's a small number, it's like 3-4%. And other countries have higher percentages. But I think that's a key goal everybody will have probably on this call is, how can I save more for my own retirement?
And it's, as you say, it's the Einstein said, the 8th natural law of the world, or whatever it was, but the power of compounding interest. So it's either working for you in the pension from 20s on, or you're getting into debt and it's working against you, isn't it? The power of compounding interest. Okay. I think we're coming up to time, so it's probably a good opportunity to say thank you to our entire audience. There's some really great questions there. We didn't get through hardly any of the ones from LinkedIn, so that's awesome. So thank you everybody who asked questions live. Thank you, Susanne, for all your knowledge and expertise. And I'd just like to plug for those who would like to. On the 2nd of November, we're having our Fintech Circle Autumn Drinks with an awesome panel discussion where you can learn all about SEIS and investing. And of course, there's lots of awesome founders and investors in the room as well. So it's a great opportunity for networking. So without further ado, I think I'll say thank you, Susanne.
Thank you, everybody, for joining us today. I really enjoyed it. Thanks, Glenn, for moderating so well. And I would say for anybody who's not gotten your questions answered, just get in touch with Glenn. Then we will respond to your questions as well afterwards via email.
Immediately. And I was going to say, actually 2 newsletters went out today, one to members, one to anybody who signed up. So all those events, because we've got a lot of events coming up in October and November, you can see those in there. So check your email. All right. Thank you. Thanks, Susanne. Take care, everybody. Bye. Bye-bye.
Bye-bye.